Hello everyone, welcome to StudyIQ. In this session, we will talk about the measures to control inflation. Okay, so measures to control inflation. So we have already discussed about what is inflation, what are the types of inflation. So if you haven't watched that video, watch that video and listen to this session so that it will be clear. You can get that videos in this Telegram channel, or you come to this Instagram ID, I can help you there. Okay, you can get in touch with me there. So measures to control inflation, we have discussed two types of inflation: demand pull inflation and cost push inflation. So here what we are going to do is, what are the measures that you're going to take to control demand pull inflation? What are the monetary measures which is done by RBI? What are the fiscal measures which is done by the government? So monetary measures we'll see, fiscal measures we'll see, and from the supply side, what are the measures that you can take, how to manage or maintain the supply, that also we will see. So first we'll discuss about, as we have discussed when we discussed about the types of inflation, we will start with demand pull inflation. Okay, so demand pull inflation is what we are going to tackle now. So what are the measures for that you will adopt, right? First you need to understand what is the reason for demand. The reason for demand is money supply. So higher the money supply, higher the purchasing power, higher the demand, more the inflation. So to control inflation which is caused due to demand, what you need to do? Reduce the purchasing power. And how can you do that? Decrease the money supply. So here solution is what? Money supply should be reduced. This is the solution. This is the objective. Now how to reduce money supply? For that you use monetary policy. Which tools you will use or what type of policy you use? We have already done this when we discussed about monetary system in India. You follow contractionary monetary policy. I'm just writing MP monetary policy. Okay, contractionary monetary policy. Or dear money policy. You make money much more dearer, more expensive. How you make money expensive or dearer? Increase the interest rates. Okay, so when you go for contractionary monetary policy, why you are going for it? To control inflation. To control inflation, you go for contractionary monetary policy. What all things you will do? You will increase the rates. CRR will be increased. CRR is the percentage of NDTL that banks have to keep with RBI in the form of cash at any point of time. So if you increase this, let's suppose this is 4% now. If you increase to 5%, what will happen? Banks have to keep more money with RBI. So banks have less money to lend. That credit creation capacity of banks will be affected. So money supply will be affected. So purchasing power will come down. So inflation will come down. So that is how CRR. SLR. In the same way, SLR also will function. You need to increase SLR. SLR is the percentage of money that you have to keep with banks themselves in the form of cash, gold, or government securities. So if you are increasing SLR, you have to keep more money, so you have less money to lend. So credit creation capacity will be less, and that lead to less money supply that can control inflation. Thirdly, bank rate you need to increase. All these are parts of contractionary monetary policy. Bank rate is the cost of borrowing of banks by pledging first class securities. First class securities are the unsecured or the securities of the private entities. For example, commercial paper, commercial bill, etc. We have discussed it already. So when bank rate is increasing, cost of borrowing of banks from Reserve Bank will increase, and cost of borrowing from banks by the people will also increase. That result into less money supply. That also will control inflation. What about repo? You increase repo. When you increase repo, what will happen? Cost of borrowing from RBI by banks will increase. This is done by pledging government securities. Exactly the same thing will happen with the public also. Public, the cost of borrowing from banks by the public will increase. So that result into less money supply. You can control inflation. Reverse repo. Reverse repo increasing means, reverse repo is the rate that RBI gives to bank when banks deposit their money. Okay, or when banks buying the bonds. When banks buying the bonds from RBI, banks give money to RBI. So reverse repo is that rate. So when reverse repo is more, banks prefer to keep more money with RBI. So what will happen? Lending capacity will come down, credit creation capacity will come down, money supply will come down, purchasing power will come down, and demand will not be there. So inflation is controlled. So all the rates have to be increased under contractionary monetary policy. So this is what the monetary policy measure that you will do to tackle inflation. Now, can it be done in case of supply? you cannot do this in case of supply. Basically, these are if the inflation is caused due to demand or because of money supply, you can do these measures, these monetary policy measures. So in case of supply, what you can do, how monetary policy can be used to increase production. Supply means you need to increase production. How can you increase production? You can, mobilize savings, financial inclusion, etc. All these ways you can increase production. But do you think that will make a much impact so that inflation will be tackled? No. So supply side inflation monetary policy measures can't do anything because it have nothing to do with production. So although if simply they're asking it can increase production, yes, to an extent it can increase production, but can it effectively be used to control inflation? No. It can effectively be used to control inflation if the inflation is caused because of money supply and because of demand, not the supply side. So that has to be clear. Monetary policies are used, rather contractionary policy is used to control demand pull inflation. Okay. Now, what are the fiscal policies? So monetary policies is done. Fiscal policy here also basically to control demand only. So it refers to revenue and expenditure policy of government. Okay, it deals with the financial transactions of the fisc, that is public treasury. It is also called as budgetary policy. Budgetary policy. Okay. Now, who is drafting this? Finance Ministry is drafting this. Now, which one is more broader? Fiscal policy or monetary policy? Fiscal policy is much broader. Okay. So, what is the statement of annual fiscal policy? It is nothing but the budget. So, budget is actually the annual fiscal policy of the government. Now, what are the tools here? Just like when we discussed about monetary policy, we discussed the tools as CRR, SLR, bank rate, repo, reverse repo, open market operation, market stabilization schemes. All these are the tools under monetary policy. Here, what are the tools? The tools or instruments of fiscal policy. First one and the most important one, that is taxes. So, what have to be done with taxes? Now, you need to understand here there are two types of taxes: direct taxes and indirect taxes, right? So what has to be done with direct tax? What has to be done with indirect tax? So what you need to do with direct tax here, objective is what? Objective I'm writing here, money supply you need to reduce. So what you need to do with direct tax? What you need to do with direct taxes, you have to, increase tax, right? So direct tax increase. So when you increase direct tax, you have less money to spend. That means your disposable income will come down. Disposable income will come down means purchasing power will come down. That will result into less demand, so you can control inflation. So I hope you understood. So direct tax you need to increase if there is an inflation because you have less money to spend. So you can suck out the money or money supply will reduce. What about indirect tax? Indirect tax, you need to do the opposite. You need to reduce indirect tax. So what will happen? The prices will come down. Price will come down, right? Because when the indirect tax is reduced, prices will come down. So automatically, directly, inflation will be tackled. So I hope you understood. With taxes, these are the measures. Direct tax you need to increase. Indirect tax you need to decrease. If direct tax decrease, that is a reason for inflation. Why? Direct tax decrease means YD will increase, purchasing power will increase, aggregate demand will increase, and inflation will be there. So direct tax will be increased here. But simply, rather than talking about direct and indirect, if simply they are asking you what has to be done with taxes, increase or decrease. If it is only taxes, you have to say increase in taxes. The reason is direct taxes share is more compared to indirect taxes. So when you're talking about aggregate, the average level, direct taxes share is more than the indirect at the central level. So what you need to do, if simply they're asking about taxes, increase the taxes. Otherwise, specific direct tax increase, indirect tax decrease. Net impact is actually when you calculate direct taxes more. So if the question is simply about taxes, you'll have to say increase taxes. because we are referring to direct taxes there. What are the other measures under fiscal policy? Other tools, government or public expenditure reduce, right? So when the government expenditure reduce means what? Like different programs, MG and RG, etc. Those expenditure if you reduce means money supply will come down. So money supply will come down means prices will come down. Simple. Okay. Then public debt or borrowings. What do you need to do? Public debt or borrowings. There are two types of borrowings. You can borrow from RBI and from others, right? From public. Now when you borrow from RBI, what will happen? RBI, as just before I have discussed with you deficit financing, right? This is called as deficit financing. So what is deficit financing? When you borrow from RBI and this is circulated in the market, so excess expenditure that lead to increase in money supply, that lead to inflation. So RBI borrowing has to be reduced. This should not be there. And now RBI government is not going for deficit financing after FRBMA. Okay. So what about public borrowing? Public borrowing, when you are not borrowing, money is with the public. But when you are borrowing, for example, you are increasing borrowing, what will happen? Money from public will go to government. Okay. So money is sucked out. Here, when you increase this borrowing, money is sucked out. But why they borrow? They borrow it to spend. So the sucked out money will automatically come to the market. So what I want to tell you is you need to borrow, but you should not spend. If you borrow and if you're not spend, but obviously when you are borrowing, you are actually spending. So that is a theoretical solution. You should borrow, not to spend. But what is a practical solution? You should not borrow at all. Okay. Now, if you can achieve all this first one, direct taxes increase, and then your revenue will increase. Here expenditure is decreased, borrowing was decreased, or you are not borrowing. This lead to what? You will get if you follow 1, 2 and 3, all these 3, you will get a surplus budget, or budget deficit will be less. Any of this, right? If your taxes or revenue is more than expenditure, then it's fine, surplus budget. If expenditure is more, deficit will be there, but if you can manage all this, your deficit will come down, and that is desirable, right? So that will reduce the money supply, that will control inflation. So in simple term, I can tell you, reduce budget deficit. Or if you have a surplus budget, that also can control inflation. So you can see here, fiscal policies are also affecting, the demand pull inflation, not the supply side, right? So if you need to, make an impact on supply side, you have to increase the production. Now question is, can you increase production through fiscal policies? See, government can give some subsidies, tax rebates, etc. And in that way you can increase production. So I'm not saying government can't, do anything with supply side inflation by fiscal policies. Government can do something, but can government do effectively control the supply side inflation by fiscal policy or through fiscal policy? No, you cannot control effectively. There can be some impact on supply, but not much impact, like in case of monetary policy. In case of monetary policy also, there may be some impact on cost of production and supply, but not much. Direct impact on the demand. Here also fiscal policy, direct impact is on the demand. So which inflation you can control through fiscal policies? Demand pull inflation you can control, not supply side much effectively. Obviously some will be percolated to supply side also through subsidies, tax rebates, etc. But not effectively. So I hope that is clear. Now we will move to supply side inflation, or what are the measures that you can take to control supply side inflation. So supply management measures. So first thing that you can do is, it is because of short supply. So if there are some items are in short, you can go for import of that item. Okay. So import the commodities which are in short supply. For example, onion prices are high because of short supply. What you can do, you can promote exports, so the supply will be more, the prices will come down. So import of commodities whose supply are less is a solution. But there's not a long-term solution because your forex is going. So this is not a long-term solution. Long-term solution we'll see. Second, what you can do, exactly opposite of this is what you need to do. You should not export, right? Those commodities which are in shortage here, you should not export. So restrict export of commodities in short supply. So this too is what you can do. What is a long-term solution? Long-term solution is obviously increase production. You can't depend on import all the time. And you can't keep on restricting exports because these are forex earners, right? So increase in production is the long-term solution, but it takes time. We can't wait, for onion to produce next year. This year, if you're in demand, you need to import. There is no other way. Okay, so there's a long-term solution. So what you can do next, you can write incentives to increase production. How? Tax rebates, etc. Right? Incentives to increase production through tax rebates, subsidies, concessional credit, technical and institutional support, technical and institutional support, infrastructural development, improving ease of doing business. All these are you can write as solutions. Then what you can do, restrictions on hoarding and speculation. Okay, we have an Essential Commodities Act, so under which you can do all this. So restriction on hoarding and speculation by invoking Essential Commodities Act, Essential Commodities Act 1955, under which government can declare a certain commodity as essential commodity and can prevent hoarding, speculation, etc. Can control exports. All those things can be done. So invoke Essential Commodities Act if there is an item is in shortage. Then most importantly, reforms in supply chain. Reforms in supply chain. Okay, the construction of warehouses, cold storages, scientific logistic management, okay, FDI in multi-brand retail, all this you can write here. Then fixation of ceiling prices, fixation of ceiling prices and administrative measures to check black marketing. But this, do you think it will be successful in developing countries? If it is an organized market, then only this provision will be successful. So developing countries, it will be difficult because there is no bills, no records, nothing is maintained. So these are the things that you can do in case of supply side inflation. Monetary policy and fiscal policy is more concentrated on demand pull inflation. Now, what are the constraints faced by government to control inflation? Let's go for that also. Constraints faced by government in controlling inflation. First, let's see supply side, because demand side you can do something because most of the things are in your hand. You can regulate money supply. Supply side, not in your hand, right? So first and most important one, no control over international crude oil prices. No control over international crude oil prices. For government of India, there is no control, right? Then depreciation of rupee is also one problem, because rupee depreciate. What will happen? Exports will be more and import will be less. You can't import when rupee depreciate because you need to pay more. More payment result into again inflation. So supply will be less. So you need to check depreciation of rupee. But can you check depreciation of rupee when you go for floating system? No. But can we say complete no? We cannot say complete no. We have a partial control over depreciation of rupee. So we'll be writing here, we don't have complete control. Why we are having partial control? We are following a managed float or dirty float. I'll tell you, I'll explain that here. So partial control over depreciation of rupee. See, this is how depreciation is happening, right? Let's say this is demand for dollar and this is supply of dollar. So this is the equilibrium point at this. The price is 60. Now if demand is increasing, let's say demand increased this much, what will happen? The 60 becomes 70. This is what you call as depreciation because of demand increase. Okay, now what RBI can do? RBI can interfere in the forex market. RBI can pump, let's say this is 10% increase in demand. RBI can pump equal amount of dollar if RBI have enough forex. Then equal change you will see in supply also. So you can see new position will be same as that of the old. So it won't change. So 10% increase in demand, 10% supply. If RBI can manage, then there won't be any problem. But is that possible? No, we don't have enough forex to do this. Okay, so there is a problem, but can we do it? Yes, we can do it. That is why managed float or dirty float. Why dirty float? Because it is not purely floating. Central bank or the government can interfere. I hope it is clear. Okay, then what are the other supply side factors? Supply side factors, what are they? Increase in production and reform in supply chain require long-term reforms. Increase in production and reforms in supply chain require long-term reforms. You can't tackle inflation immediately. Then political constraints in reducing expenditure. See, if you are reducing public expenditure, this is actually going to affect the government, or next election it will be a problem, right? So political constraints in reducing public expenditure. People take it in a negative way. If you reduce the expenditure on NCA and RGA or the public expenditure, it is not desirable from political side, although it is good or required from economic side. Okay, so these three is the constraints from supply side. Now this is from demand side. Next is limitation of monetary policy, right? In increasing interest rates. Okay, limitation of monetary policy in increasing reserve requirement and interest rate. See, I have already told you need to increase interest rate to control inflation, but RBI can keep on increasing interest rate, then it will affect the growth. Okay, RBI have to manage growth also. RBI is a part of government. RBI have to manage the growth also. So you can't keep on increasing interest rates, although inflation targeting is the prime objective. Okay, so there is a limitation in that. See, if CRR, SLR, all this increase means automatically what will happen? It affects the lending capacity of the banks. The bank's profit is all about lending. So the profitability of bank will come down. So that will create into a lot of problem. Bank will go for loss, bankrupt. That will be a big problem. Okay, it will affect the entire economy. So you can't keep on increasing interest rates to control inflation. That is a limitation, very big limitation. Similarly, if repo is increasing, CRR and SLR is directly connected with profitability of the bank. Repo is increasing, it affects the industries because investment will decrease and it will directly affect the growth. Okay, so all these are restrictions from monetary policy side. See, if crude oil price decrease, what will happen? The problem is crude oil price, right? As I've told you, increasing crude oil price, which is not in your hand, is the problem. Let's say crude oil price decrease. So overall macroeconomic situation will improve. How? What will happen? The demand is inelastic in case of crude oil. Whether the price is increasing or decreasing, we have to import the same quantity, right? So if the price is decreasing, what will happen? Import remain the same, so import bill will come down. Import won't come down, import bill will come down. Even the price is increasing or decreasing, it does not affect our import, right? Crude oil is inelastic. We need this much amount of crude oil. It is for sure, certain. So import bill will come down. That is good. Because of that, trade deficit will come down. You go back to the balance of payment chapter, you will understand all these concepts. Trade deficit will come down. You can get all the videos here in this Telegram channel. Trade deficit will come down. So current account deficit will come down. So when current account deficit will come down, automatically rupee appreciate. Okay, so rupee appreciate, then budget deficit, what will happen? Budget deficit will improve. Okay, so now do you think you need to give a subsidy to fuel, because price of fuel already came down, otherwise you are giving subsidy. So that subsidy can be, subsidies on fuel can be eliminated. Because of that, government expenditure, what will happen? Come down, because no subsidy now. Revenue, what will happen? Revenue will increase. So there is a positive sentiment. So now government expenditure come down. So what will happen? Inflation come down. How? Because government expenditure come down means money supply came down. Inflation come down. So now RBI can do what? RBI can reduce the interest rate. So interest rate can reduce. If investment will be more, what will happen? Growth will be more. Okay, so that will increase the GDP. So I hope you understood how this crude oil is connected with the entire economic situation in India. Just one point is what you need to know. Crude oil